Hi, my name is Richard Levin. I'm the chair of the FinTech and Regulation practice at Nelson Mullins. I'm joined by my colleague, Brad Rustin, who's the chair of our bank regulatory practice. We are happy to have you join us today for our presentation on custody of digital assets. You could go, okay. Today we're going to talk about a couple of different areas. We're going to discuss distributed ledger technology, or what's known as blockchain technology, to help you understand what is driving both the development of the industry and the regulations. We're going to walk through the differences between blockchain technology, digital currencies, digital assets, and wallets. We're also going to be introducing you to the views of the Comptroller of the Currency with respect to regulation of custody of digital assets by focusing on two pieces of guidance: a letter from from 2020, and then a second letter from 2021. We will also talk about the SEC's view of the OCC's letter from 2020, and then we will talk about regulation at one of the states which has taken the most active role in regulation of digital assets, the state of New York with their BIT license. So in the United States, regulators focus on trying to understand what are digital assets. Digital assets can be either a commodity, they can be a currency, they can be a security. Now, the problem is many of the laws that are used to regulate currencies, securities, and commodities were written in the 1930s, 40s, and 70s. This was a time when the laws were written, people wore leather football helmets to play football, so we're now refereeing a football game with rules that are far out of date for the scope of regulations. Unfortunately, the laws were not designed to address digital assets or digital currencies. So the regulators, the Comptroller of the Currency, the Securities Exchange Commission, the CFTC, and states like New York have been working diligently over the last 10 years to establish a regimen for regulating each of these types of assets. In the presentation, we're going to use the term digital asset to cover the broad category of assets which may be using distributed ledger or blockchain technology. These can include currencies, coins, tokens, or what are known as digital asset securities. With respect to digital asset securities, the federal securities laws do not define when a digital asset is a security. This is something that the SEC has crafted most recently. Next slide, please. So when we talk about blockchain technology, the first thing we're looking at is how these transactions are recorded. And what I'm going to do is turn it over to my colleague, Brad Rustin, to walk through more detail on blockchain technology.
Thanks so much, Rick. And when we talk about blockchain, we're really talking about is how do we create an authoritative record of transactions? How do we create a system of what's called nodes or operators, people all working together, who are then agreeing on a common set of transactions and what becomes an official record. If you think about traditionally, that was done at a centralized point of contact. You had, for instance, in your bank, a core provider that hosts your official record of transactions for the bank. Really what we're talking about when we start talking about blockchain or distributed ledger technology is a way of shifting that so that different operators, different nodes, all working together to maintain the, quote, official record of transactions associated with that particular ledger. We'll use an example that was created by the Federal Reserve that I really like. If you think about it, we've got a series of people who are all working, we'll call them nodes or operators, and each of them is keeping a record of transactions. In an ideal world, everybody agrees. We all compare notes, if you will, and we say, yes, absolutely, we all agree these are the transactions associated with this particular product, this particular contract, this particular Bitcoin, whatever the case may be, and there's consensus or agreement amongst all the operators. And then you say, okay, what happens when something changes? When something changes, one of the operators or one of the nodes, if you will say, I have a new transaction to add. And suddenly the entire network that we're talking about here notices that something doesn't match. In the example the Chicago Fed uses, we're using this fancy barcode that codes to Chicago Fed 0. Suddenly, one of the nodes says, I'm submitting a transaction. They say the new set of sequences is Chicago Fed 100. The entire set of nodes notices the error And then there's got to be some way to reconcile or fix the ledger so that all of us come back into consensus. And that's really the secret to blockchain or distributed ledger technology, is this concept of validating or fixing those discrepancies. And it can happen any sort of way. Some distributed ledger technology is in fact not distributed. There's an official central authority that approves changes. Other times, there are ways of voting, meaning all the various nodes vote on what the official record is, and then they all have to adopt what's elected or voted in as the record. Many of you who are potentially considering banking or working with Bitcoin in particular, Bitcoin is somewhat unique in that it uses the concept of miners. These are folks who are hosting computer systems that have massive computing power. And every time we add a transaction to the chain for a particular Bitcoin, it creates a new cryptographic giant math problem that has to be solved. And the solution to that math problem, if you will, is a key that the owner of that particular Bitcoin is in possession of. And when somebody wants to transfer a particular Bitcoin, they say, here is my private key. I assert that the solution to the math equation is this. And then the miners all go out and they run this massive mathematical sequence and say, yes, that is a solution to the equation, and here's my work. And the benefit, why you want to be a miner, is you get rewarded with Bitcoin for doing that, for validating those transactions and showing your work to the entire world. The neat thing that this creates then is every block of Bitcoin is a history of that coin. It can go back forever. You can't change the transaction record, and it's indelible. All you can do is add to it. The other thing, the neat thing about this network and why so many folks are interested in it, it's very secure, which is in order for you to commit fraud on a distributed ledger technology, is you'd have to corrupt multiple nodes or operators. And so it becomes really difficult because you'd have to go out onto the entire network and get all the different nodes to agree on your fraudulent transaction. And that's part of the inherent stability or the inherent fraud protection associated with it. And so because of that, you can see why things like Bitcoin, cryptocurrency, or DL tech, distributed ledger technology, has become so popular because of those inherent strengths and the anti-fraud protections associated with it. Rick, back to you.
Now, anytime that we're dealing with assets in the United States and we have multiple regulators involved, it does create a level of confusion for the institutions that are regulated. So banks having to be managed by the OCC, by the Fed, or by state banking regulators, dealers of securities having to answer questions from the Securities Exchange Commission, and firms that are dealing in commodities or commodity futures or commodity swaps or derivatives having to deal with the CFTC. Now, the Securities Exchange Commission has been at the forefront in this space for a number of years. And in order to address whether a digital asset is subject to their jurisdiction, they have crafted this new definition of what they refer to as a digital asset security. And what they're looking at is whether the asset that is issued and transferred using distributed ledger or blockchain technology is acting in a manner that makes it look like an investment contract, meaning that was it used to raise capital? Does it have the characteristics of a debt instrument, an equity instrument, or some type of security-based swap? If it does, the SEC will say that is a digital asset security subject to their jurisdiction. If it is a digital asset that looks more like currency, they will leave that to the jurisdiction of the Department of the Treasury's Financial Crimes Enforcement Network, or to state regulators who are dealing with the regulation of money service businesses and payment processors. If the digital asset has the characteristics of a commodity and that it is traded in a manner that looks like a commodity swap, a commodity future, or a commodity option, the SEC will leave that to the CFTC. The problem is this leaves a plethora of regulators who at various times assert jurisdiction over firms in the space. And it requires firms operating in the space to operate with a great degree of caution, because every time they are involved with a product, they need to determine, are we acting, for example, as a custodian of a digital asset that is a security? Are we acting as a custodian of a digital asset that is not a security or a currency? Are we acting as a custodian of something that could be deemed a commodity or a commodity swap or future or an option? So as firms work in this space, they have to proceed with a great degree of caution.
And so we'll start with a little discussion of digital currencies, and frankly, Rick gets to talk about all the neat cutting edge stuff with securities and what have you. I'm going to start a little bit more historically and talk briefly about banks that are providing services to digital currencies. You know, when we think about digital currencies, it's probably a very limited world that it truly classifies as currency. But when we talk about a digital currency, it's a coin or a digital asset or a cryptographic token that's really not speculative. There's no securities aspect associated with it. It's not being used to raise capital, you know, any of those issues that Rick just mentioned. Instead, it's truly being used as a means of exchange. It has a value that's set by the market. People take fiat government currency, they convert it into digital assets, in this case cryptocurrencies, and it becomes a means of exchange. It can be used to buy goods or services, by other currencies. You know, unlike fiat currency issued by government that's backed by the full faith and credit of a government, you know, whether that's the US government or another, digital currencies are either backed by what the market says it's worth. Think Bitcoin. Every day the price of Bitcoin goes up and down based on the perceived value of it. Or it can be what's called a tether coin, meaning it's somehow tied to some asset or fiat currency. You can have coins that are tied to gold. You can have coins that are tethered to the US dollar, what have you. But, you know, when we talk about, think about this very narrowly, which is a true cryptocurrency is something that is a means of transferring value for goods or services. It's not speculative. It's not an investment contract. You know, and really as we as bankers think about this, we can see just how quickly this market has grown. If you look at the Fed Reserve update from the end of 2019, the number of cryptocurrencies has skyrocketed in essence in the last 4 years, from 2015 to 2019. As of today, the total market capitalization of cryptos is over $1.11 trillion because there are so many that are currently living out there. You know, when we talk about digital currencies, FinCEN has taken a very, very narrow approach to it. When we talk about Treasury's approach, what they've done is, in essence, treat it as a means of transferring money. It's not a currency. It's not a foreign exchange that is also a type of regulated money services business. Instead, it's treated as money transmission, the movement of money between people or between locations. And as you think about banking people playing in this space, remember that generally FinCEN has taken the position that anyone who converts fiat, government-issued money, into digital currency is a money transmitter, has to be registered with FinCEN, subject to BSA, AML, and OFAC obligations. Anybody who converts digital currency to digital currency or allows for transfers of digital currency between people or locations is a money transmitter, subject to registration with FinCEN, subject to BSA, AML, and OFAC. If you provide a digital currency ATM, meaning you're changing out either money for cryptocurrencies or cryptocurrencies for fiat money, also a money transmitter. Recently, you've seen guidance coming out from FinCEN that folks who act as what are called mixers or currency anonymizers, people specifically focused on helping owners of digital currencies anonymize the ownership of it, also subject to FinCEN, also a money transmitter. Anytime you're dealing with digital currencies, unless it is simply someone who is mining cryptocurrency or paying in cryptocurrency for goods or services, generally they're going to be classified as a money transmitter by FinCEN. One really interesting thing to remember as bankers, if you are going to bank folks in the digital currency space, the exemptions from money for merchant payment processing and the other exceptions to money transmission registration do not apply to digital currency. So there is a very commonly used exception called merchant payment processing, where an intermediary processes payments to businesses that are owed money for goods or services. They're generally not classified as money transmitters. Those exceptions have not been extended to digital currency payment processors. So something really to remember there because of that exchange of value concept.
It's interesting, Brad, when you mentioned the anonymizer function, oftentimes people will say that cryptocurrencies are anonymous. And generally, that's not true. they provide a degree of pseudonymity the same way a bank account number is a digital representation of the name of the account holder. And in fact, people have gotten in trouble in this space where they thought that they in fact were anonymous, only to find out later that no, it was a pseudonym. The best example is Ross Ulbricht, who ran a crypto platform called Silk Road. The federal agents who arrested him found his computer. They associated the pseudonym with his identity, and he is now serving multiple consecutive sentences in a federal correctional facility. Unfortunately, 2 federal agents who were involved in apprehending Mr. Ulbricht also did not realize that when the government seized his Bitcoins, they then tried to misappropriate some of the Bitcoins, and they did not realize that the blockchain created a record of that misappropriation. Those federal agents are also now serving time in a federal correctional facility. But as Brad pointed out, FinCEN is concerned about platforms that are designed, in fact, to create a higher level of anonymity from pseudonymity in this space. So when we talk about cryptocurrencies, you'll also hear people talk about wallets. Now, wallets are basically an electronic mechanism for the storage of digital assets on the web, on servers, hard drives, mobile devices, even on paper printouts. You can have the key, which then allows you to release the funds from the digital wallet. When a digital wallet is created, it's basically connected to a cryptographic public key with a string of numbers and letters, and each key has a matching private key known only to the user. You may read stories about people losing their key and losing millions or tens of millions of dollars of Bitcoin. That can happen if you do not use cryptographic wallets that have mechanisms for storage and preservation and retrieval. So there is a risk depending on how the digital asset wallet is designed. Now, when we talk about wallets, though, a wallet, in effect, is a custodian of a digital asset. And if the digital asset is a security, the Securities Exchange Commission will say, is that custodian properly qualified to hold a digital asset security? And there have been questions that have come up with operators of platforms for both cryptocurrencies and digital asset securities, attempting to ask the question, is a state chartered trust company a suitable custodial location for what's known as the Customer Protection Rule, 15C3-3? Is it a proper control location for an investment advisor? These are issues that the SEC and FINRA, the frontline regulator, have been working for the last year to resolve and provide guidance to the industry.
Yeah, that's a really good point, Rick, that, when we talk about this, there are a lot of gray areas that we really need to be aware of, such as what is the difference between providing a repository for these keys versus actually custodying these assets. And I guess, subject to your input, it sounds like there's still a lot of development as to where these various lines will be drawn by the various organizations as to those issues. When we talk about digital currency, the other thing to remember as bankers is, just like with any money services business, FinCEN places the obligation on the banking services providers, the banks, the federal savings banks, the credit unions, et cetera, to diligence the folks whose accounts they are hosting, not to provide or facilitate access to the Federal Reserve System, payment systems, settlement systems for individuals that are operating unlicensed money services businesses. And in the past, FinCEN, as well as the prudential banking regulators, have pursued claims against banks, including through the Department of Justice, for facilitating illegal money transfers, illegal money services business operation, people who were not properly registered with FinCEN. In kind of a bellwether event in February of 2020, the OCC for the first time took action against a bank that was facilitating cryptocurrency-related transactions for unregistered MSBs, money services businesses. And so you see it referenced there, but that's really the first step, and this is the warning to financial institutions who are considering their relationships with digital currency providers that by facilitating those transactions, you may bring liability into your bank for facilitating unregistered MSBs and their access into the payment systems, in essence, Fed settlement, or facilitating their business operation in violation of Treasury rules. Generally, everything we see with MSBs remain an obligation of the banks as you consider your relationships with with digital asset providers or digital currency providers, which is make sure you're doing your customer due diligence and really make sure that if you're going to play in this space, you understand the legal and compliance obligations associated with digital asset providers, custodial services associated with that, or cryptocurrency or digital currency transactions. In particular, where we always see people getting caught in enforcement orders is really making sure you understand not only your BSA AML obligations for your institution, but also the BSA AML obligations that are applicable to the underlying provider of different services, meaning if you're working with an exchange, if you're working with a custodian, even if you're working with a digital wallet that hosts these private keys, making sure you understand both their obligations and yours. And then, as Rick is going to point out a little bit later, understanding for those that are potentially classified as securities, what your obligations are as an institution for banking folks working in a security space and what those SEC obligations are. And are they complying with state laws as well? Don't forget, we always have both the federal obligations at Treasury and the SEC, but also state securities regulations as well as state currency or in some cases, as Rick's going to point out a little bit later on, states that are specifically regulated in the digital currency space. And then mainly making sure, as with everything, you can properly manage the assets, making sure you can properly manage the relationship and you fully understand it so that you can demonstrate your knowledge and awareness of the risks associated with it.
So as we look at the regulation of digital currencies and digital assets, in July of 2020, the Comptroller of the Currency published an interpretive letter recognizing that national banks may provide custody services for cryptocurrencies, including providing storage for these cryptographic keys associated with the assets. This was a watershed moment. Brian Brooks, the Comptroller of the Currency, the acting Comptroller of the Currency, previously was the general counsel of Coinbase, one of the leading cryptocurrency trading platforms, which recently has filed to go public. This opened the door to banks providing services similar to escrow services for the keys and for digital assets, including storage of digital certificates, web-based document storage, retrieval and collaboration with respect to documents. The letter does provide for custody of cryptocurrencies, will require banks to provide, custody for the keys, and they reiterated that national banks have to have the authority to provide custody for this type of digital assets. The OCC also made it very clear that it believes it has the power to authorize national banks to provide these types of services. This has been an issue of dispute. Several years ago, the Comptroller of the Currency proposed a FinTech charter for banks, which has resulted in litigation between the Comptroller of the Currency and state banking regulators who claim that the banking laws do not preempt state law in this area and that this is beyond the scope of the Comptroller of the Currency's authority. So we do anticipate under a new Democratic administration in both the White House and both houses of Congress that this will be an area of focus and that the new Comptroller of the Currency will be scrutinized for any actions they take authorizing the custody of digital assets going forward.
Really great point there, Rick, particularly as we move into the new administration, because there's potentially a change in tone at the top, both in this and many of the FinTech initiatives that the prior OCC, FDIC have been pushing, particularly as they work towards FinTech models and increasing the role of the national banks or the state banks in those types of FinTech models. The big thing is what the OCC has done with this 2020 letter is really broadened what it considers the prudential powers or the banking powers of a national bank. And they've really broadened it out so it could be exchanges, it could be transaction settlement, trade executions, everything down to record keeping, valuation, and tax services that they believe are commensurate with existing rights to provide custodial services. Then truly acting as a custodian for the digital assets or a custodian for the cryptographic keys. All of these OCC has broadly interpreted to fall within the powers of a national bank to provide these, including acting in a fiduciary context and providing these as a trustee or in other fiduciary contexts where the bank is actually acting on behalf of other third parties in the same way it does within its existing trust department, subject to the rules and regulations associated with trusting those assets.
So in addition to the 2020 letter, the OCC has flagged issues that enables the banks to hold custody. Now, this creates a question whether under the Investment Company Act, a bank holding cryptocurrencies is a suitable control location for an investment company, whether it's a suitable control location for an investment advisor to a registered investment company or to investment company entities that are exempt from registration under the Investment Company Act. And then the last point, it also raises the question of whether these types of institutions, banks, are suitable control locations for digital asset securities under Rule 15c3.3, the Customer Protection Rule. So following the 2020 letter, the OCC published a set of guidance. The SEC published a set of guidance in response, making it very clear that they reserve the authority to themselves to determine, for purposes of investment advisors, investment companies, and broker-dealers, whether a certain bank was a suitable control location for purposes of the Investment Advisors Act, the Investment Company Act, or for purposes of the Securities Exchange Act, which applies to broker-dealers. And they then published at the end of 2020 a statement and request for comments regarding the custody of digital assets for broker-dealers. Most importantly, this statement does propose a 5-year period that will allow broker-dealers to operate in certain very specified circumstances and not be subject to enforcement actions if they are holding digital asset securities in a specified control location.
Then following that SEC letter, we get in January of this year, January 2021, OCC published another interpretive letter, the 2021 letter, that in essence responded to what the SEC was saying and reconfirming the authority of national banks and federal savings associations or federal savings banks to actually participate in the node verification networks, just like we talked about earlier, where we have those different operators and nodes who are each, coming in and verifying those transactions. A national bank or a federal savings bank could provide those types of services, and it's really even further broadening not only traditional concepts of banking and custodial relationships, transaction clearing and payment, but actually taking one step further and saying you can participate in the node verification networks and serve as a node that is verifying transactions. And as the quote here by Comptroller Brooks noted, it's really designed to be broad. That is, national banks are given broad power to transact business associated with blockchains, digital assets, and digital currencies. In essence, banks are in a very good position to provide those services because they've done it traditionally with other payment systems and other custodial relationships dealing with securities and commodities. Really, the takeaway from this is the existing OCC, subject to any changes in the administration, is really taking a very broad, very expansive view of what a bank or a federal savings bank could do in terms of providing services to the digital asset world. Kind of on that same note, then, when we look at the press release that came out with the 2021 letter, re-emphasizing again OCC, the need for technology development in the blockchain system. And, we see even more an endorsement of these types of payment networks. As we talked about, because of the nature of distributed ledger technology, they can help eliminate fraud. They can be used in very creative ways that simply, single source payment systems do not work well with. Meaning, where you're trying to create a network of different individuals all able to post transactions and prioritize them and reach resolution on them. And generally, the OCC has been expressing confidence that banks know how to manage these risks. Now, caveat with that, as we all know, with our relationship management obligations, you need to make sure you do, in fact, have the resources to manage this if your institution is thinking about working in this space. But truly, the position of the OCC has been that digital assets, cryptocurrencies, digital currency, commodities are all similar to existing assets that are custodied by banks or managed by banks, and therefore banks are in a very good position to provide these types of services. As we think about kind of what the effect of that 2021 letter is going to be, is more and more we think national banks are going to help provide payment services in this space. We've talked a little bit about the creation of stable coins and other types of coins that are used, or either through tethers or through other mechanisms to create less volatility and fluctuation in the coin marketplace. As we noted here, we've already seen some major international banks starting to play in the space, issuing stable coins and creating a system where the banks are providing the services that right now are created through this very fragmented state by state regulatory regime, where different exchanges or hosts or issuers are operating under different national laws, different state laws. And truly it's creating this very broad view, similar to how the OCC has approached FinTech charters and others, that going back to the National Bank Act, is these are very, very broad rights given to national banks to provide security to the banking system, and generally a very broad interpretation of what those rights would be. Rick, back to you.
In addition to the regulation of digital assets by the FCC, the CFTC, the Comptroller of the Currency, you also have state regulators. The most prominent action taken by a state regulator was by the New York Department of Financial Services in June of 2015, where they adopted regulations for virtual currency businesses in their state, what's commonly known as the BIT license. And the licensing requirements are fairly stringent. One of the problems that you run into is that if you are doing business in New York in a manner that falls within the licensing regime, you are going to have in place compliance policies, comply with capital requirements set by New York Department of Financial Services, meet prescribed customer protection and asset custody standards, keep certain books and records, and be subject to NYDFS examinations, have an anti-money laundering program, and establish and maintain customer complaint processes. Many states are also looking at adopting or have adopted their own version of regulations of virtual currencies. For example, Louisiana adopted their law for currency of virtual currencies, or for custody of virtual currencies, in August of 2020. However, New York is the most aggressive state with respect to, next slide please, it doesn't grant reciprocity. So if you are conducting business in the state of New York, you may have to get a New York BIT license, even though you normally would be licensed in your own state, and then would believe you would have reciprocity in every other context. New York to date has not recognized reciprocity with other states for purposes of the BIT license. This slide walks through what brings you within the scope of the BIT licensing regime. I would encourage you to take a look at it. We could spend a little more time after the call with you. There are exemptions from the BIT licensing and reciprocity. A number of those are identified here, but again, if we leave you the most important point, New York is not recognizing any type of reciprocity as of now with other states. So if you hear people getting chartered in South Dakota, Nevada, Wyoming recently, the problem is that those institutions will more than likely have to either become licensed or fall within the scope of the BIT license exemptions in the state of New York.
Yeah, and that's a great point you make there, Rick. It is very similar to what we see in the MSB space, which is simply having a license in one state. Oftentimes, regulators, particularly state regulators, are going to take the position that providing the services to residents of their state itself puts you within the regulatory regime of those various states. And so more and more of those businesses are looking to banks to partner with so that they can offer, whether it's MSB services or in this case, digital asset, cryptocurrencies, or commodities through bank partnerships. And so particularly if you're going to be banking these folks, you really need to understand those various risks associated with the state regimes as well as the federal regimes, so that you really can understand what these obligations are, particularly, as you noted, some of the more aggressive states, such as New York, that has articulated a very clear position that trust companies, limited purpose trust companies, others offering any sort of digital asset, custodial services or trust services would have to comply with that particular state's law. Rick, your thoughts?
So as we look at custody of digital assets, hopefully you realize from this presentation that it is rife with complex issues. You have state and federal regulators all focused on what is a proper custodial location, and much of that will depend on the assets that are being held at that custodial location and the applicable legal regime. Are you acting as a custodian for an investment advisor that may be setting up a commodity pool to invest in crypto, or a investment company or an exempt fund that is holding digital assets or securities? Are you working with a broker-dealer that may be holding digital assets that are securities? Each of these will require banks and custodians to determine what are the appropriate legal regimens and how do those, in effect, square pegs fit into the round hole. So as you go forward in this space, we would encourage you to proceed with caution. Caution should be your watchword, because both federal and state regulators can take action against an entity that is violating the law with respect to a proper custodial location, depending on the type of asset, and also making sure that any firms you choose to do business with or associate with are properly registered, because we would hate for your firm to get dragged into an investigation or enforcement action by virtue of working with an entity that is also not properly licensed for the business that they are conducting.
Yeah, that's a really great point, Rick. As institutions begin to play more and more in this space, really knowledge is the power to offer this in a responsible way, which is understanding the myriad of potential pitfalls or traps that exist, whether those be the Treasury traps or the SEC traps, so that your institution, your financial institution, really has a feel for what it is you're either banking or providing, and understanding exactly what is the black and white rules, where are the gray areas, as you mentioned here, even going so far as concerns about FDIC insurance and what does it apply to. I mean, this is constantly developing. Monitoring is key, as well as really understanding this world in order to for your financial institution to play in this space.
Thank you for taking the time to join us on this webinar today. If you have any questions about the topics that were covered during this presentation or any other issues with respect to FinTech and digital assets, please do not hesitate to reach me or my colleague, Brad Rustin, at the telephone numbers and emails that are listed at the end of this presentation. Thank you very much.
Thanks so much, everybody.